Throughout history, governments and money have always been intertwined. Now, money must enjoy the support of the private sector to carry any value, but governments have always been involved to provide some degree of trust.
What do people need to know about digital currencies going forward and how it might affect their lives, their future, or end the world as we know it, Chris?
Whenever you go from an analog to a digital construct, your choices become infinite, your design choices. So just as it can be designed to be a privacy eroding and censorship imposing instrument, so it can also be designed to be a privacy protecting and a censorship resistant instrument. If we simply put our hands up and say, no way, no how, then we don't have a seat at the table. Let's make it clear to policymakers that privacy must be central. If we get privacy wrong in a digital dollar, it will be a disaster. But let's look at it the other way. If we get privacy right in a digital dollar, how powerful would that be? And for those who say, no, just leave it to the private sector to design money. Let's let the private sector. Well, how has that worked out in the area of speech to operate the public square in the form of Facebook, in the form of Twitter? Let's look at the prospect of sovereign and non-sovereign digital money as an opportunity to upgrade privacy. And there's no question that the future of money is networked and digital and programmable. Let's use this digital revolution to regain what we've lost.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs, sharing our vulnerability, overcoming our fears, transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Chris Giancarlo, the investor, attorney, author, and blockchain technology advocate. You served as chairman of the U.S. Commodity Futures Trading Commission from 2017 to 19, where you oversaw the first Bitcoin futures products. You've been named as one of the most influential people in financial regulation, and your views on cryptocurrencies and digital assets are regularly featured in the Wall Street Journal, the Financial Times, and CNBC. You are the co-founder of the Digital Dollar Project, the not-for-profit initiative to advance the exploration of a U.S. central bank digital currency, and you are also the author of the bestseller CryptoDad, where you suggest that, quote, money is too important to be left to central bankers. You believe we are now at a critical stage in the development of the digital dollar, and that if done correctly with economic freedom and privacy, we will position the dollar as the global reserve currency for generations to come. Chris, welcome back to London Real.
Brian, it's great to be with you and great to be back.
I loved our conversation last time. It was a year ago, Chris. How quickly and dramatically the world has changed in just 12 months. Maybe walk me through what your view was of the last year, kind of the big moments, your thoughts of them, because there's quite a few events there. And then obviously the last 3 months has been quite headline, worthy with the FTX debacle and SBF. What were your thoughts on the year?
A lot of people come up to me and say, Chris, what the hell has gone on in crypto? Where are we and what's happening? And the way I try to respond to that is I say, the first thing you need to do is carry in your mind almost two separate concepts. And if you can do that, I think a lot of this makes sense. So the first concept is crypto is a highly speculative new investable asset class. The second concept is digital assets in crypto as an entirely new internet-based architecture of value, including money itself. Why are they different? Because the second one, crypto and digital assets, is a new architecture. you might liken to a new technology like, say, railroad architecture in the 1870s. The first, crypto as a new asset class, you might liken to railroad stocks in the 1870s. And why are they different? Because of the coming of the railroads allowed countries like the United States to evolve from small, unnetworked regional economies into the national economy that has become the world standard for the largest and fastest growing economy of the last 150 years. But yet railroad stocks were notorious in the 1870s for fraud, manipulation, misrepresentation. Now, some of them were very real. They funded the Continental Railroad, but others funded fraudulent railways that didn't even exist, that didn't have the right rights of way, and people lost their money speculating. Others made money. So they are very different things. Crypto and digital assets more broadly is a brand new architecture. It's an internet-based architecture of finance. That's a very powerful, and it's going to continue to be a very powerful, and I'll get into that in a minute. But that's very different than crypto as a speculative asset class. And when we think about spectacular failures of FTX and others, it's in that funding side of it. It's in that railroad stocks aspect of it. It's not in the underlying technology. What happened with FTX, failure of all the traditional failures that we've seen in financial markets, it's not a failure of the underlying technology. If people can keep those concepts separate, it's much easier to understand. I feel like we've gone through the wildcatting days of this new technology. But every wildcatting error yields to a more fundamental, disciplined, thoughtful error where the technology embeds itself and becomes part of our world. And I remain as confident as ever that this new architecture is what's going to remain. The world is not going to say, oh, FTX, so therefore let's go back to 3-day settlement periods. Let's go back to writing paper checks. Let's go back to branch banking. That's not going to happen. The genie's out of the bottle on the technology, notwithstanding the spectacular failure of some of the more prominent players in the first phase of this crypto architecture revolution.
Yeah, it reminds me a bit of the dot-com boom. I was actually in New York City. I've been hired at the tender age of 27 to be the CFO of a dot-com startup called LuxuryFinder.com. We were selling private jets online, got about 15 million of funding, a couple of very famous investors in New York City. And we rode the wave right up. And I was out with my banker buddies out on the town telling them this was Columbus in the New World. And they were all looking at me, rolling their eyes. And of course, in 2000, everything crashed. But, and of course, I've heard you reference this before. There was pets.com and petstore.com and all these iterations. Now, the market went up in value and down in value, but the underlying technology never lost its purpose, right? That was still incredible. And that kept developing. It's just the asset prices overshot and then definitely came back and undershot. But fast forward 10, 20 years, that technology has fundamentally changed who we are as humans. You're saying this is a very similar analogy to that?
So let me actually give you some data to support exactly what you just said. When pets.com failed in 2000, there was about 350 users of e-commerce. Pets.com did not fail because people didn't want to buy pet supplies online. Pets.com failed because people didn't want to buy pet supplies using dial-up modems to connect with the website. They didn't want to wait 3 weeks for the pet supplies to arrive because the delivery infrastructure wasn't there. And they didn't want to pay ridiculous valuations for companies like pets.com. Within 10 years, by the year 2010, there were 2 billion users of e-commerce. And by then, Amazon had arrived on the scene selling books, and eBay had arrived. And by 2020, there are now over 6 billion users of e-commerce online, and it's driven stock market valuations and others. E-commerce is part of our lives, but it took 20 years for the infrastructure to build out. The promise of e-commerce, the valuation of e-commerce had gotten far ahead of the underlying infrastructure, the mature players, the disciplined players in the market, and sensible valuation. So the promise had gotten ahead of the reality. And I think we've seen the same thing with digital assets and crypto. The promise of an architecture that's not based upon accounts kept at proprietary institutions of where value is, but value established on the internet through protocols and protocols like crypto protocols like Bitcoin or ETH and others, and distributed ledger technology, it really hasn't yet built itself out. So this is very much your analogy, Brian, exactly spot on.
It's funny, I remember in my dot-com startup days, funny enough, some founders talking about railroad stocks, fascinatingly enough, because I think we saw a lot of fiber being laid at that time, especially in New York City, and they were making these similar analogies, like it was a big boom, and they were talking about how most of these railroads went bankrupt, and the analogies were very similar. And look, you and I worked on Wall Street for decades, and we saw this centralization problem occur many, many times. Of course, Bernie Madoff is a good example, but we've seen it where a small amount of people have power. They do things that they shouldn't be doing. Enron, maybe mortgage crisis, maybe Madoff, but go back every 10 years and you'll find something on Wall Street. And this was another one of those. DeFi definitely didn't fail, and we can talk about that. And then the underlying tech itself is maybe tainted by FTX, but nothing's changed. It potentially is a superior technology, and you think it will prevail in time.
I'm certain it will. To think that somehow the internet will not do to finance and banking and money itself what it's done to retail shopping, social networking, entertainment, leisure, travel, communications, but to transform those from systems that operated through proprietary rails owned by firms to an internet basis is the same thing is going to happen. Now, will it happen in a revolution all at once? No. There are still corner shops you can shop in alongside e-commerce outlets. And in the same way, bank-based finance is not going to go away, but a new form of value, establishing value and who holds value and who transfers value to whom, using distributed ledger technology on either wide open internets or closed nets is absolutely the direction that the future is pointing us in.
What did we learn from the events of the last 12 months? I mean, the big things on my radar were Terra Luna failure, probably Celsius, FTX. Those are probably the big ones. What did we learn, and what were the ramifications? I guess, what would you say were the lessons and the magnitudes of those things?
So look, I'm a big believer in decentralized trustless systems, but until we get there, trust is still critically important. And betrayals of trust are extraordinary breaches of the social fabric. The allegations about what exactly happened at FTX still have to come out in full, but we've been reading a lot of newspaper stories. And based upon what we've read, it looks like a combination of Bernie Madoff, Nick Leeson and Barings, and John Corzine and MF Global. And why do I say that? Well, Bernie Madoff traded off the fear of missing out, right? A big shiny object of his fabulous returns, everybody wanted to get in. Well, you had some of that here, or apparently it appears we've had some of that here. Nick Leeson, traded himself into a bad trading position and just thought with more leverage and more trading, he could trade out of that position. And all he did was create a bigger and bigger hole, right? Until it eventually was unsustainable. And then lastly, John Corzine and MF Global, the temptation if you're running a trading book that you've got to maintain margin on your positions to dig into customer accounts to support that is what we've got here. Now, all of those failures are failures of traditional marketplace. They're failures of trust in systems that require trust. And that's what we had here. There's nothing about that combination of factors that's particular to crypto. There's nothing about that combination of factors that's an indictment of internet-based digital asset systems. And yet, it will be used, it is being used by those who have agendas, whether their agenda is, I told you so, crypto is wicked and bad, or whether it is, I'm in favor of this regulatory agency or that regulatory agency having power. It will be used just as the failure of pets.com, You can find headlines in the New York Post and others saying, that's it for online e-commerce. E-commerce is dead with the fall of crypto. Well, that wasn't the case at all. You'll see in the short term a lot of silly narratives that people are going to be embarrassed by 3 or 4 years from now. But look, that's the nature of human society. People will use this, but it's not an indictment of the underlying technology or the promise of it.
Yeah, well, I want to talk about some of the fallout and what we might expect from a regulation perspective. Funny enough, Chris, I had Nick Leeson right here in this room a few years ago. And, for a guy that worked on Wall Street in the city of London for many years, having him here was pretty epic because, we all remember, although the young kids don't remember. And when I mentioned this guy lost $1 billion, people are like, that's it. But I said, back when $1 billion was a lot of money, this guy took it out and almost took out the Bank of England because he took one error trade basically and wouldn't cut his losses. And I use this example to my students all the time, and then tried to trade out of it and brought down a bank that the Queen used for hundreds of years, right? It was
the great names in finance, right?
Yeah.
A trusted name. There was a name, that you had trust in. And it's amazing how hard it is to build trust and how quickly it can be dissipated.
I had Anthony Scaramucci on a couple weeks ago, and he had sold 30% of Skybridge to Sam, and he was out in the Middle East introducing Sam to investors out there, and he said one thing which you just maybe reminded me of. He said, Brian, when the Luna thing happened, they obviously were taking heavy losses there, and he said what they could have maybe done is said, look, Alameda's busted. I'm going to wrap this thing up. We're going to take our hits. But Mooch was like, look, the FTX was a thriving, potentially global marketplace for crypto. It had everything going for it. He's like, if they could have just taken the losses, shut down Alameda, and not tried to use those funds and trade out of it, he's like, I still think that this could have been something that would have been saved. But they doubled down and went out of it. What are your thoughts on that observation?
So actually, it's a right on observation. So I come, you mentioned my background on Wall Street. I come at markets from the trading platform side. Before I went into government, I helped run GFI Group, one of the world's premier trading platforms for over-the-counter swaps. It is a adage in markets that's as old as time that trading platform operators must be neutral to parties on the trade floor. There's a reason why the New York Stock Exchange doesn't run a hedge fund. There's a reason why the London Stock Exchange is also not running an asset management firm or trading for its own account, right? At GFI Group, we never, traded money on or put money to work on our own exchange. These things do not go together. And most modern regulation, including the regulation that I oversaw as chairman of the CFTC, separates trading platforms from trading houses, right? They are separate animals. They must be kept separate. And why is that? Because the temptation is too great if you're running a book to maybe dig into the accounts of people trading on your platform to advantage yourself or help yourself out, especially if you get yourself into trouble. So there was always something problematic into the FTX exchange sitting side by the Alameda trading house. And so I think that is something that is, as crypto regulation, and by the way, when I was using the analogy of pets.com and the infrastructure not being mature enough, part of that infrastructure is our regulatory infrastructure. Regulatory infrastructure, especially in the US, which was written in the 1930s, was written for an analog physical world, a physical delivery of stock certificates, a very different world we have today. And so, the regulatory infrastructure hasn't yet caught up, but I expect it will. And when it does, I'm quite certain that what you will see is traditional separations between trading platforms and people that run books, that run proprietary trading books. Those are things that in the natural order of human activities should be separate, must be separate. And I believe that regulation will make sure that in the crypto world, they are separated as well.
Well, let's talk about that because, as you said, it was a trust issue. But then again, this trust missight would have never happened in a traditional financial market. And you and I both know that. Even internationally, in any G30 country, something this epic proportions probably in this day and age would have been hard to pull off. Of course, it did happen as recently as 10, 12 years ago in other places, but it would have been hard. But since this was crypto, it was a different ballgame for a variety of reasons. And maybe we can dive into them. First of all, this was located in the Bahamas, because nobody was sure about if they wanted to be in the US. And a lot of people have blamed the SEC for lack of clarity. I don't know if that's fair or not. I'm curious what you think. Also, it was a new asset class with a new 30-year-old CEO who seemed to be smarter than everybody, and they were driving it forward. And I remember a couple of years ago, Chris, when I really dove into this space, I remember thinking, what is Alameda Research? It sounds like, I don't know, weird, some scientific firm, or is it some like startup investing firm? It was never really clear what was going on, and everything was moving so fast that I don't think anyone had the time to check. And so, what were the failing points? And then maybe finally, how do you regulate this asset? Because you work for the CFTC, the SEC is involved, but even both of those institutions used to regulate these older type of instruments, and you just said it's almost like a railway. It's an algorithm. It's not clear what it actually is, crypto.
Yeah, so Brian, fascinatingly, I think you just cataloged all the failures. Let me actually identify, however, the one pocket of the whole thing that didn't fail. And the one pocket that didn't fail was the piece that was under traditional regulation, which was CFTC regulation of derivatives. So the piece that didn't fail and still is operating well today is the Bitcoin futures market. It remains liquid, it remains active, it remains transparent, it's operating. That's in the asset class. As far as the FTX empire, the one piece that didn't fail was their ownership of FTX US, which is the old LedgerX, which is a regulated derivatives platform under CFTC regulation. And it's the asset that, from what I hear, people are hoping to buy out of bankruptcy and operate because it didn't fail. It's functioned well. Now, the reason I say that is not to toot the horn of the CFTC, but to say that these old regulatory frameworks, if they are updated and repurposed, can serve rather well. I do believe, and I've long been an advocate for a bespoke set of regulation in the US for crypto. That doesn't mean new regulators, but new statutory authorities. But until we get there, regulators can repurpose old rule books. And we did that at the CFTC in 2017 when we greenlighted Bitcoin futures, which has worked well. Subsequent to that, the licensure of LedgerX, which was subsequently bought by FTX, and continues to operate without failure. So I'm a believer that with the right vision and repurposing, legacy regulatory frameworks can be repurposed. And ultimately, at the same time, I'm hoping that, again, on the U.S. side, that Congress steps in with bespoke legislation. And look what Europe's doing with MiCA legislation. I don't think it's perfect. I think it's got some challenges in it, but it shows that policymakers can look at this new architecture and design frameworks that are appropriate for it. And I think that's what we need to do more broadly.
All right, so a lot of people in crypto immediately pointed the finger at the SEC and said if they had been clearer, these entities, and then there's a lot of them worldwide, right? There's the Binances of the world, there's the Crypto.coms, there's the FTXs. They stayed specifically off American soil, which also meant no tax revenue, maybe less jobs, et cetera, because they said there was a lack of clarity from regulation, specifically from the SEC. Is that fair? And what is the way forward?
Yeah. So here's what I would say. When we looked at this during my time in office at the CFTC, we said this is a new asset class. There's a lot of challenges here. So our first job was to get smart about it. And in the spring of 2017, we launched something called Lab CFTC to make ourselves as smart as we could be about the new asset class. To the point where, I'll give you an anecdote, in the summer of 2017, we were doing synthetic Bitcoin mining in the chairman's conference room at the CFTC with all the commissioners present, just so we can understand what the concept was. Walk us through, the different concepts. So that's the degree to which we wanted to get smart about this. So by the time we were then faced with the choice of licensure and greenlighting the launch of Bitcoin futures, we had already gotten ourselves up the learning curve. I think that's duty number one of regulators. Get smart about it. Number two, recognize that technology has its own path forward. you can't stop the movement of time. You can't dictate market structure. What you have to do is follow the trends and direct it in a way that is beneficial to the marketplace, that brings out that furthers the principles that your mission is focused on: fairness, transparency, honesty, integrity in markets. But follow the technology. Don't try to bottle it up and say, well, we like markets circa 1982, and therefore we're forever going to hold back innovation. So you've got to accept innovation in markets, not try to stifle it. I think that's principle number one that we tried to do at the CFTC. The other point is, once we realized that this was moving forward, what we said is, let's create a pathway that may be, in the case of crypto, we actually called it heightened scrutiny. We made the pathway slightly more challenging, actually not slightly, somewhat more challenging than a standard non-crypto product certification. But we said, look, the pathway is going to be at a slight incline over others, but we're going to light the pathway. We're going to tell you what it takes. We're not going to, operate in shadows, so you don't really know what the pathway forward is. At the CFTC, the pathway to greenlighting a Bitcoin futures, the pathway to getting a license for a crypto derivative exchange is clear. It may be difficult, but it's clear. And we felt it was our duty as regulators to say, we're not going to hide the ball. We're going to tell you where the path is. It may be a challenging one. It may require a higher degree of scrutiny. Our team is going to spend more time on your application than perhaps we would with a new wheat future contract or some sort of new metals future contract, which the agency has been looking at for 50 years. This is a new asset class, so the scrutiny is going to be tighter, but the pathway will be clear. And so I would say that's the third requirement of regulators, to clarify the pathway forward, not mystify it, clarify it. And I think we were successful in doing all three at the CFTC, and I think that should be the model, if I might say so, for other regulators. That is, get smart about it, clarify the pathway forward, and engage with the industry.
Well, if I make an opinion, I see no indication any of that is happening currently in the regulatory body of the SEC. I mean, I took the Series 7 exam. I'm sure you did too. And the Series 63, I took mine in 93. And I learned about, I think it's the Securities and Exchange Act of 1933, I believe. So it's a piece of legislation almost 90 years old. And I learned all about that. And now I'm hear from that organization that it's a security, everything's a security, but Bitcoin doesn't pass the Howey test and you better look out. And I hear comments like, no honest man should fear the SEC. And I don't know, it just doesn't seem very helpful. Look, I'll just straight up ask you, is this an old way of looking at new instruments? Do we need to completely revamp? Because saying it doesn't pass the Howey test seems like the completely wrong question to be asking about this asset. Who cares? It's a completely different instrument. So I don't know, what are your thoughts?
Well, look, as a former regulator, right, I'm evidence that regulatory administrations and their point of view come and they go. Nothing lasts forever, right? So I'm not sure that the current state of the SEC that many people complain about is the permanent state. I think, things will change. Doug Adams, who's the author of the Hitchhiker's Guide to the Galaxy series of books, one of my favorite authors, has a great quote, and I'll paraphrase it because I never get it right. But he says that, look, anything that was invented before you turn 35 is way cool and is something that you want to devote time to and maybe make it a lifelong career. But anything that comes about after you're 35 is suspect, dangerous, and needs to be suppressed. With crypto, that generational divide is as great as it ever was. In fact, I'm old enough to remember something we called the generation gap in the 1960s. And it was over things like civil rights and the war of Vietnam. There was this gap between young people and their parents. I think that gap is as alive today, but it has to do with really the future, a networked future. Young people understand networks, digital networks. And yet older people don't understand why we need to change. There's, for them, there's nothing wrong with branch banking. There's nothing wrong with paper checks and 3-day settlement cycles. And that generation will yield to a younger generation. So part of what we have here, and I don't want to accuse any particular people of this, but we do have a generation gap. The people, we have a particularly septuagenarian of leadership in our financial markets, in our central banks. And I think to them, in many cases, what was wrong with the old world? And they will be replaced in time, whether it's this year or next year or 3 years from now. The technology will march forward, and eventually a new leadership will emerge into those positions of power that intuitively understand digital networks. And they'll bring with them an openness and a sensitivity. So the current generation, that if it's for comfort levels or technology, I don't want to say hysteria, but technology dissonance, will yield to a generation that intuitively understands this, and it will happen. And whether the resistance currently is at market regulators or central bankers. I mean, I've spoken to people across the spectrum, across the globe, at market regulators, prudential regulators, central banks, and there's a mixture of real hesitancy because they just don't get it, and they like the world that existed before. And there's people that get it and want to march forward. Eventually, the people that get it will simply generationally emerge in the majorities at these institutions, and the change will happen. But it will take time.
I think Peter Thiel called it the geriocracy, I think is what he called it. And maybe that does have to die out. In the meantime, though, as United States of America, and even though I am a citizen of this country and America, I still consider myself quite American. It's a little embarrassing that the country that should be leading the charge in this, matter of fact, some people say it's the only technology in the last 50 years that America hasn't dominated. And it's probably true. And then even today in 2023, I still don't know if I'm able to start a new crypto company in America, and I probably wouldn't. I'd probably go move somewhere else. So that's a shame.
Let me just leaven that a little bit.
Okay.
You're absolutely right, and as an American, I feel the same way. I feel that this is not the 1980s and 1990s when we led the charge in developing the internet to begin with. We led the first wave of the internet. The second wave, the Internet of Things, we yielded to others in terms of development of 5G technology. But this third wave, the Internet of Value, I think it's still a closely run thing where the U.S. will be. And why do I say that? Because stablecoin development has still been largely U.S. dominated. A lot of crypto infrastructure has some strong U.S. players involved in it. And I would say from the regulatory state, putting aside what other regulators have done, it's been 5 years now that the CFTC led the world in creating the first regulated marketplace for any type of crypto, and that was in crypto futures. I know a small part of the marketplace, but Bitcoin futures, Ethereum futures are working well under sound regulation, transparently, liquidly, and are serving a lot of risk hedging needs in the marketplace. So the United States has not been absent, but I do agree with you. It's a close run thing whether the United States will bring the same degree of dominance. And you know what? Maybe a more global approach might be a good thing. Where you see the most adoption of crypto is where societies are young. In young countries, Africa would have a high birth rate, a lot of average population under 30, you see a high adoption rate. And in mature societies, this geriocracy that we have in, unfortunately, many Western countries, we see a lot of resistance. And I think part of that resistance is that generational divide that I talked about earlier. But that generation will yield to a younger generation that will intuitively get it.
I appreciate that point. And we do want to get to stablecoins and, of course, the digital currencies, because this is where you are the expert. You're definitely the number one guest I've ever had on this show that really talked straight about the digital dollar and what's happening in China. I want to get to that. Before we do, just want to ask what you think will be the future of regulation in America. One of the things I found very entertaining, or not entertaining, I don't know what it was, eye-opening, about the FTX hearings in both the Congress and the Senate was, oh man, I don't know what to say. I find these hearings fascinating. Anything live happening in DC from the Supreme Court Justice approval a couple years ago, I think is probably the most fascinating live TV. But I saw experts rolled out. I mean, you must have been cringing at some of these experts that were saying these things have no value whatsoever, pure speculation, it's rat poison squared. And then also at the same time, I saw people with agendas from both parties just using this event to advance their or settle scores within the conference. And I'm not a politician, but it was obvious to me by watching it. I'm curious if you saw similar things that I did on both of those hearings. And then how will this play out, do you think, in regulation?
So those agendas, that's what Washington is all about. Those agendas will continue to play out. There are people that are pro CFTC, pro SEC, and they will run op-eds and run stories why the other agency is out of its mind and this is the right agency. So that's normal. You're going to have people that are pro self-regulation, that are anti-regulation. They're going to play out their agendas. There are going to be scores settled. If you take away all of that noise, I think there are two pieces of legislation that will garner enough majority and interest across the aisle to have a chance of seeing the light of day in the current Congress that was just sworn in. The first one is stablecoin legislation. I do think we're going to see some form of stablecoin legislation. I think at a minimum, there is bipartisan support and across the House support, Senate and House, for disclosure legislation for stablecoins. At a minimum, if you're operating a stablecoin, and if you say this is the stablecoin mechanism, you have to be truthful. You've got to explain what it is and be truthful about what it is. And probably there's got to be some auditing process to actually confirm what you say it is. I think there's core support for that across the House. The second question will be who can operate stablecoins? Must you be a licensed bank or must you have a special license to do it? I think there's some challenges there. There's some contingents that like to see that limited to established banking institutions or at least someone who holds a bank license. There are others that think it should be more broadly. What's the role of states? I think there's still consensus building to go on there. But I think stablecoins will see the light of day for one reason. Stablecoins are considered, I think, because they hold U.S. treasuries as a demand factor for U.S. debt. And so in a country that, lives on debt and is issuing spending more and more money all the time, the need for demand, I think that if nothing else, and I think there are other reasons, but I think that's one reason why we may see stablecoin legislation in the future.
Okay.
I also think because prudential regulators want to make sure they're in the driving seat regulating this. And I think the likelihood of bank and central bank involvement in stablecoin regulation is great. The other area where I do think there remains support is to fill a gap. And that is, it's now clear that certainly Bitcoin, when it's used as a derivative, futures and swaps, is regulated by the CFTC. And cryptos that serve the function of capital formation instruments and therefore are securities are regulated by the SEC. The SEC has authority over both spot markets and derivative markets for securities. The CFTC has only authority, except for a few limited exceptions, for only the derivative market for commodities like Bitcoin and Ethereum. Why is that? That sounds strange, right? The SEC has both derivatives and spot. The CFTC generally only has derivatives. Well, if you think about it, it actually makes sense. The CFTC oversees gold futures, but doesn't oversee gold markets, because if it did, it would have to regulate every corner jewelry shop in America. The CFTC oversees wheat futures, but if it oversees spot market for wheat, it would have to oversee every grain elevator in America. The CFTC oversees cattle futures, but doesn't oversee cattle auctions. If it does, it would have to have agents in every cattle watering hole in America. Those are long been assumed that spot markets are under state regulation and the futures markets are under federal regulation with the CFTC. But there are a few exceptions already to that in the area of foreign exchange and others. And it is very likely, I believe, that the CFTC is going to be granted authority over spot markets for Bitcoin and Ethereum. There's a whole bunch of reasons for that, but it makes sense. If the CFTC has got 5 years experience overseeing the derivative markets, it makes sense for it to have the spot market. That's what it's already happened in other categories. So I believe there's a strong likelihood that legislation will pass. It was introduced in the last Congress. It has bipartisan support. It has cross-house support. And although some people are driving an agenda have tarnished it because they said, well, FTX supported it, therefore it must be bad. But just because FTX supported something doesn't make it bad if the underlying premise of it makes sense. And here's why I think it'll be beneficial. The CFTC already regulates Bitcoin and Ethereum futures. Because it regulates the futures, the SEC has greenlighted an ETF on Bitcoin and Ethereum futures. If the CFTC is given authority over the spot market for Bitcoin and Ethereum, now the SEC will have no objection to greenlighting a spot-based ETF. And therefore, as a former trader, once you've got the full suite of futures, swaps, spot markets, and ETFs under effective regulation, now traders can have a field day with all the different product sets necessary to have a full curve of prices and suites. So I think this could be a real beneficial turn for Bitcoin and Ethereum if the CFTC were given that spot authority and then the SEC saw its way to an ETF on that spot market.
Yeah, that sounds like a wonderful option. But the SEC just said Ethereum's a security, right? So we have to get over that first.
So it has the CFTC. So I'm not sure. All the legislation that's moving in Congress, where it actually determines what's under CFTC jurisdiction, puts Ethereum alongside Bitcoin. There is no legislation in Congress right now that says Ethereum is under the SEC. So I think, the fact of the matter is the CFTC has had oversight of Ethereum futures now for almost 4 years. So again, there are agendas out there, and whenever you've got institutions in a political state, you've got partisans for those. I'll admit my own support for the CFTC, right? You've got partisans for those institutions. But if you break it down, the CFTC is 5 years running overseeing Bitcoin and Ethereum futures. I think it would be unlikely, and none of the current pending legislation supports the SEC being of authority. But look, I'm open to other suggestions. I think this will get hashed out in Congress. I'm just giving you my prognostication and my own view that I think the CFTC is the right regulator for Ethereum and Bitcoin spot markets.
Yeah, well, you got my vote as well. I'm all for the CFTC regulating this stuff, and I hope it happens. But of course, as they say in Washington and other places, never let a good crisis go to waste. So it feels like they will use FTX for a lot of different agendas there. It's already happening. Some seems to be losing steam. We'll watch how this plays out. I want to jump in to the digital dollar and maybe a little bit of stablecoin. I mean, you mentioned the stablecoin regulation. I guess that means something like USDC would come out with glowing colors. Tether is probably going to be under the gun and have to do a lot of explaining if this regulation comes out. I guess we can see what happens. But maybe we jump into the digital dollar because this is something that comes up time and time again. It's something that initially, if we're honest, Chris, probably scares people when they hear about the concept of the digital dollar. Now, I think when you start talking about it, you can explain why maybe that initial fear isn't correct. But when people usually hear about it, it sounds like this instrument of censorship, instrument of surveillance, instrument of control that's going to be used by governments, and you quickly go down this dystopian reality, and it sounds really bad and really scary. We obviously get examples of what's happening in China with this. When you were here on my show, you gave some of the most up-to-date, incredible information on this. So let's just start. What do people need to know about digital currencies going forward and how it might affect their lives, their future, or end the world as we know it, Chris?
Well, Brian, thank you. When you called and said, hey, why don't you come on the show?
To continue watching the rest of the episode for free, visit our website, londonreal.tv, or click the link in the description below.